All right, y'all, pull up your seat. Let's talk the difference between APR and APY. Now, if you remember, I had three concepts, financial concepts that you all should do some research on last week, and I hope you did it because we got to level up our financial literacy. But let's go ahead and dig into it. We'll start with APR. APR means annual percentage rate, and it applies to the percentage that a banking institution would charge you to loan you money. So think car loan, mortgage, personal loan, credit cards. So for instance, I think the credit card rate right now is 29%, y'all, which is nuts. But what that means is that you could be charged up to 29% per year on the balance that you're holding on your credit card, which is precisely why you got to pay your credit card balance off. And it also is very deceiving because it does not take into account the compounding interest that accrues on a daily basis. So today you are paying interest on the balance plus the interest from yesterday. Today that balance is higher, and tomorrow you're being charged for the balance and the interest that you have accrued today. So every day you're paying interest on a higher balance, which is exactly how and why your credit card balance grows so quickly. All right, so let's talk about APY. APY means annual percentage yield, and it refers to the percentage of money that you are making off of the balance that you are holding in a savings account. We like APYs. So annual percentage yields can be anywhere from like 0.01% all the way to like 5% or more. It just depends what banking institution you are holding your savings account in, and it also depends what kind of savings account you are holding your money in. APY does account for compounding interest, and in much simpler terms, a much simpler way to understand this is when you think about APR, it is an expense because it's the money that you owe on a balance. And when you think about APY, it is income because it is the percentage that you're making on a balance. And boom, in 2 minutes, you've just leveled up your financial literacy. Now save this and send it to someone else who could use the information.